Hey, good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. Should be an action-packed couple of weeks ahead, but we'll see. Maybe less fanfare than what we're expecting. We've got the Treasury's quarterly refunding. A couple of years ago, we were asked by one bank executive, who's going to absorb all of this increased supply? Our answer was the domestic account base. We do believe the numbers support that at this point, but nonetheless, we know we're running these $1.5 to $2 trillion deficits, really wartime deficits when the economy is good. We're not saving for a rainy day. We have fiscal owls, not hawks at this point. So maybe no big changes within this period with this refunding, but certainly subject to increased supply issues as we head into 2025. But some of the best yield levels that we've seen really in quite some time, the last 5-6 months, not the best yield levels of 2024, but it will be a good test at these yield levels depending on where we are heading in. Third quarter GDP, we're running above trend growth. Keep in mind some of the repricing that we've seen in this market on the rate side, which really began in and around 380 in U.S. nominal 10 years with that ISM services number of 55. We got the employment number, and it sort of went from there. And here we are some, 50, 60 basis points later off the lows of 360 in UST 10-year as we head toward the employment report and the election and the Fed meeting next week. The employment report, PCE deflator, year over year headline expected to come in and around the Fed's target. We know the core number is running at a spread to that, anywhere from 2.5% to 3% year over year. But these month-to-month numbers, the Fed needs to be 0 to 0.2 to feel comfortable on a consistent basis, that we're not only heading toward 2%, but we're going to maintain those levels over time. We don't see the PCE deflator being a game changer. You look at the price of oil, we're collapsing overnight. Israel, Iran, very, very constructive, slightly higher CPI number earlier in the month. But we don't think the inflation data is the here and now story. There are risk factors coming out of the election heading into 2025 for a potential reacceleration, but that's not the story of the moment. The employment number, look, it's asymmetric. If it comes in weak, and there will be distortions around some of the weather factors that we've seen in Florida, North Carolina, but the reality is where the expectations are for a softer print. If it comes in softer, we're priced for the Fed to go 25 in November largely. And if it comes in much stronger than expected, perhaps some volatility here in the blackout period ahead of the election, ahead of the Fed meeting on November 7th. But expectations are for a tempering in these employment numbers. And then we head into next week. We have the election, obviously front and center. The early voting is sort of neck to neck in terms of Republicans and Democrats, which is a slightly different dynamic than what we saw in 2020. So we lean toward having some sort of outcome on November 5th. We could be wrong. Some people feel that way. Others feel differently. If we have a more protracted event, state by state, the counting of votes, our opinions will change. But keep in mind, again, markets have been repricing here. So a good portion of what we've seen on the rate side in terms of repricing has been in term premium, right? So term premium levels now positive again, not quite to where they were in October of 2023, but certainly on the move higher volatility, animal spirits around the election. We have been repricing and skewing that way. Are we fully priced? It's impossible to know exactly whether or not we're fully priced with these moves. It's always impossible to know whether we're fully priced, but certainly, at least with regard to rates, markets have been on the move in anticipation of potential election outcomes. And then the Fed meeting, gradualism, right? No rush to get to neutral. No one has a clue where neutral is. We have estimates in terms of nominal neutral. But keep in mind here that this Fed went 50 basis points before the election to now move past the election and follow that up with nothing would seem a little disruptive, would not be a good look in general, we think, for Fed Chair Powell. Do they get 2 more rate cuts in 2024? That remains to be seen. The data is not necessarily warranting that. So if it's 1 out of 2, we would favor November over December. If it's 2 for 2, we're going to get November and December, obviously, and then head into 2025. The forward curve is repriced higher. We agree with that repricing. We were priced way too rich to the Fed's projected long-term neutral rate of 2.80. And then short term, we'll see how things shake out. But we do favor the Fed continuing to come down here. The spirit of gradualism will be what you will hear from Chair Powell next week. It's what we heard broadly from the committee. New York Fed President Williams saying, 2 more rate cuts is the baseline. But certainly, I think what you will hear from the Fed next week, if they go another 25, is this spirit of they are in no rush to get down to this neutral rate. We think it's wise. Let's see how the election plays out. There were mistakes made in 2021 where the stars aligned for a lot of spending. The Fed kept the balance sheet prime. They kept rates at 0. The end result was inflation. We can't make that mistake again. Wishing everyone a great week ahead. There's a lot on the table. I'm Greg Faranello. I'm head of U.S. rates for AmeriVet Securities.